Imagine you just got your offer letter. $60,000 a year, you read it twice, you smile, you text your mom, you do the quick math in your head. 60,000 divided by 12, $5,000 a month. That is the number you are going to live on. 5,000 a month. Rent, groceries, gas, a little fun. It feels survivable. It feels almost generous. For the first time in your life, the math seems to work in your favor. Then the first paycheck hits your account. It is not 5,000. It is not even 4,000. It is $2,603.92. You open the pay stub, you read it 3 times, you stare at the number. You are not bad at math. You are not lazy. You did not miss a meeting. You did everything right. You just learned in $2,603 that the number on your offer letter was never the number you were going to receive. You ask a coworker. He shrugs. He says, yeah, that is how it works. He has worked here for 6 years. He has never sat down and calculated where the missing money goes either. You ask another coworker. Same shrug. Same answer. Nobody around you can name the gap. Nobody can break it down. Everybody just accepts that the number on the offer letter and the number in the account are different. There is a quiet trick built into how Americans talk about salary, and almost nobody explains it before you sign the paper. The number on your offer letter is the gross number. The number that lands in your account is something else entirely. The gap between them is not a mistake. The gap is the entire point. Most working Americans do not know exactly where the gap goes. They just know it is large, it is permanent, and nobody walked them through it. Tonight we walk through it, line by line, dollar by dollar, so that when 60,000 becomes 31,247, you understand exactly what happened to the rest. The first cut happens before the money is ever yours. Federal income tax. On $60,000 of gross income, single filer, standard deduction, in 2025, the federal tax bill is roughly $6,100. That is the first slice, $6,100 that you will never see, never touch, never deposit. It is taken before the money exists in your account. The second cut is state income tax. The amount depends entirely on which state you happen to be born in or move to. In California, on the same $60,000, you owe the state roughly $2,100. In Texas or Florida, you owe $0. Same job, same salary, different state, different paycheck. Your geography is part of your compensation. Almost nobody calculates that when they take the offer. For the average American, state tax pulls another $1,500 off the top. The third cut is the one almost nobody talks about. FICA. FICA stands for Federal Insurance Contributions Act. It is the payroll tax that funds Social Security and Medicare. The Social Security piece is 6.2% of your wages. The Medicare piece is 1.45%. Together, 7.65%. On $60,000, that is $4,590. Gone before you see anything. And here's the part most people miss. Your employer pays another 7.65% on top of that. So the actual tax on your labor is 15.3%. Half is visible on your pay stub. The other half is invisible to you and quietly reduces what your employer is willing to pay you in the first place. If FICA did not exist, your salary would be higher. The tax is on the labor, not on the worker. The bill is just split so you only see half of it. So far, we have removed $6,100 for federal, $1,500 for state, and $4,590 for FICA. We are at $12,190 removed, and we have not touched any of the deductions yet. This is the part the offer letter never mentions. After taxes come the deductions. These are the things you signed up for during onboarding. In a stack of paperwork you read for about 90 seconds while a stranger from Human Resources watched. Health insurance. The average employee contribution for single coverage in the United States in 2025 is about $1,400 a year. For family coverage, it is more than $6,000. That comes out of your paycheck every pay period before you ever see it. Then there is dental, vision, sometimes life insurance, sometimes short-term disability. Each one is a small line. Each one is automatic. Each one you forgot you agreed to. Across all of these, the typical worker is paying somewhere between $1,600 and $2,000 a year in benefit premiums alone. Then comes the retirement contribution. If you opted into a 401k at 6%, which is the most common default, that is another $3,600 routed out of your paycheck. That money is technically still yours. It is sitting in your retirement account. But it is not in your checking account, and it is not available for rent or groceries or the emergency that has not happened yet. Add it up. Roughly $5,600 in deductions on top of the $12,190 in taxes. You started at $60,000. After taxes and deductions, you are at $42,210 in actual take-home. But we are not done. There is one more layer almost nobody includes when they think about their salary. The taxes you pay after the paycheck lands. Sales tax. Every time you buy groceries, gas, clothes, a coffee. The average American pays around 6 to 8% on most purchases. Property tax if you own. Rolled into rent if you do not. Either way, you are paying it. The landlord is not absorbing it. Gas tax. Every gallon you put in your car has a federal tax of 18.4 cents and an average state tax of around 33 cents on top. Excise taxes, phone bill taxes, utility taxes, vehicle registration, the 100 small fees that nobody counts because they each look small. For a typical American household earning $60,000, these post-paycheck taxes consume another $6,000 to $7,000 per year depending on the state. That brings the real number, the genuinely yours number, the money you can actually use to build a life, to roughly $31,247. Out of $60,000 on the offer letter, you are keeping 52 cents on the dollar. Now look at it from the other direction. You worked 2,080 hours that year, 40 hours a week for 52 weeks. That is the standard full-time American work year. At $60,000 gross, your hourly rate looks like $28.85. At $31,247 net, your real hourly rate is $15.02. Half of every hour you work goes somewhere else before it touches you. This is not an accident. This is not a glitch. This is the design. The system is set up so that the number you negotiate, the number you celebrate, and the number you live on are three different numbers. And almost no one teaches you the difference before you start working. There is a reason for this. It is called tax salience. When a tax is taken out before you see your money, you do not feel it the same way you feel a tax you have to write a check for. Economists have studied this. People react far more strongly to taxes they pay manually than to taxes that are deducted automatically. If you had to write a check for $12,000 every April, you would notice. You would have an opinion. You would vote on it. When the tax goes through your hands and out again, you understand its weight. When the tax never enters your hands at all, you barely register it. The withholding system, the one where your employer sends the government your taxes before you ever touch the cash, was created during World War II. It was sold as a wartime convenience. It was supposed to be temporary. It was supposed to expire when the war ended. It was never repealed. Because once a government discovers that people barely notice taxes that are taken before payday, it almost never goes back. This is why your paycheck is shaped the way it is. Not because the math is complicated, because the math is hidden. So how do you push back? You cannot opt out of federal tax. You cannot opt out of FICA. You cannot vote your way out of withholding overnight. The system was built around your paycheck before you were born. It will outlive your career. The rules are not negotiable for one person. But the rules around how you respond to the system are. You can do 4 things that quietly recover thousands of dollars a year. Rule 1. Read your pay stub, every line, every pay period. Most people have never looked. Most people do not even know how to log into the payroll portal. Read it. Understand each deduction. Know the difference between gross, taxable income, and net. The single act of reading the stub is the difference between being inside the system and being managed by it. If you do not read it, the system reads it for you, and the system has different priorities than you do. Rule 2. Front-load your pre-tax accounts. Money you put into a 401k or HSA is not taxed at all in the year you earn it. That means every dollar you contribute reduces both your federal and state tax bill. For someone in the 22% bracket, every $1,000 contributed to a 401k saves around $220 in federal tax alone. The math is simple. The default is to not do it. If your employer matches, the math is even better. Skipping the match is the closest thing to leaving money on a table that the system allows. Rule 3. Adjust your W-4. If you got a refund last year, the government held your money interest-free for 12 months and gave it back without interest. A refund is not a gift. It is a return of an overpayment. Adjust your withholding so the refund shrinks toward zero. The same money lands in your account every 2 weeks instead of once a year, and you can put it to work immediately. A $2,000 refund is $2,000 that could have been earning interest, paying down debt, or sitting in your emergency fund. Instead, it was sitting in the Treasury, doing nothing for you. Rule 4. Track your effective tax rate, not your bracket. People obsess about being in the 22% bracket. Almost no one calculates what they actually pay. Your effective tax rate is total tax divided by total income. For most Americans earning $60,000, the effective rate after every layer is around 48%. That is the real number. Not 22, not 12, 48. Because the bracket is one tax. The real bill is the sum of every tax, every deduction, and every cost that gets removed before you can use the money. If you measure the bracket, you will manage the bracket. If you measure the effective rate, you will manage your life. None of this means the system is going to change for you tomorrow. It does mean the gap between $60,000 and $31,000 stops being invisible. It means the next time someone tells you their salary, you know it is the gross. You know the take-home is something else entirely. You know the hourly rate is roughly half of what the offer letter implied. It means when you get a raise, you know that a $10,000 bump on paper is closer to $5,000 in your hand. It means when you negotiate gross knowing it is a starting point, not an end point. You ask about the 401k match. You ask about the health premium. You ask what state the role is in because that is part of the salary. It means you stop being surprised by your own paycheck. The number on the offer letter was never the lie. The lie was that anyone explained what the number actually meant. The system did not break. The system was built this way. The withholding is automatic on purpose. The deductions are automatic on purpose. The paycheck arrives smaller than the contract on purpose. Nothing here is broken. Everything here is working exactly as intended. The only thing missing was someone telling you. Now you know. How much of your gross salary do you think you actually keep? Drop a number in the comments. Just your honest estimate. The real number for most people is harder to look at than they expect.